The Federal Reserve is moving to crash the economy. They have no choice and Powell is trapped. Interest rates are going to keep rising and my base case now is 5.5% at the very least. Even BlackRock believes that rates are going up to 6% and stay there for an extended period of time. I want us to understand how Jerome Powell has miscalculated horribly with his statements. The Federal Reserve is losing any credibility they have left. Now, back in February, Powell told the world that we are in the early stages of disinflation, but we all know that he's daydreaming about the economy. Any monkey knows that prices are still elevated and the inflation crisis isn't over yet. And guess what? The Fed is now doing a dramatic U-turn. He knows there's no escaping the pain. According to Powell, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. The Fed was trying to influence the economy using just words. Powell doesn't want to pay the price of a recession, but it's now impossible. It's now too late. He will have to raise rates to crush inflation. So if you're heavy into stocks or considering buying real estate, things could get really ugly very soon. Now I want us to take a look at the yield curve today. An inversion is a powerful predictor of a recession. He has forecasted all 9 recessions since 1955 with only one false signal. That's a 90% accuracy. And when the yield curve inverts, it tells us that a recession is likely coming within 6 to 24 months. And I don't know about you, but I trust the yield curve much better than the Federal Reserve's forward guidance. And what do we have? The steepest bond yield inversion since the Volcker era of the 1970s. Things are really getting very bad now. The market is predicting a hard landing and the day of reckoning is coming. Just take a look at the treasury yields. A 6-month is paying above 5.2%, while the 10-year is well below 4%. And this tells us that investors are fearful. They are putting lots of money into bonds on the long end. Money is getting sucked out of the system and the mood is getting ultra bearish. And we have to realize that Powell is trapped between Biden and Putin and he can't control what both of them are doing to the global economy. And let's understand that Powell only has one tool to control inflation, which is raising interest rates. It's a horrible tool, but he can only control the supply of money and it's only partial control. But when Powell is busy sucking money out of the economy, we have the US government busy pumping money into the system, right? They are still spending like crazy, the fiscal policy is out of control and still at odds with the Federal Reserve's monetary policy. And let's just use one great example, which is the defense budget of the United States. We have the US Senate passing a record $858 billion defense budget for 2023, which includes a pay increase for the troops and buying tons of weapons. And now the Pentagon is seeking another $835 billion from the US government for defense build-up. That is a total of nearly $1.7 trillion. And we know this isn't going to end because they are chasing the Chinese boogeyman, who's also increasing its defense spending by over 7%. Now, the problem with war spending is the inflation chaos you are unleashing in real time. You are borrowing money from the future or printing it through the Federal Reserve to buy raw materials from the open market. You're buying oil, you're buying metals, you're shrinking the supply of commodities while expanding the money supply. And this is what the Federal Reserve has to deal with. They have warned time and time again that rate hikes won't be enough if government spending stays high. Powell has no choice but to raise interest rates to destroy demand from the everyday Joe because obviously he can't possibly tell Biden to stop spending. And this brings us to Powell's other inflation nightmare, which is Putin. Now, if you have been following the economic war, you probably know what Russia is doing. Russia is striking back on the G7 oil price cap with their own counter strategy. They want to keep inflation high in the West. Russia has rerouted the majority of their oil away from the West towards Asia. We can see the volume lost to Europe has been taken up by Asia. They ramped up their Russian oil imports by over 1 million barrels a day. Now, Putin has also cut oil production by 5% in March and is moving for deeper oil export cuts in Western ports, which is only going to cause inflation to go up. Now, the US has to compete with Europe for a smaller pool of oil and gas, which is going to keep inflation high. And when your energy costs are elevated, everything goes up, right? Gas gets more expensive and food prices also soar. And that's why Powell is trapped. He can't control the supply side of the equation, so he can only hike rates up to destroy demand. But here's the deadly truth. Powell actually knows what it will take to crush inflation. He knows he will have to destroy a ton of jobs and crash the economy to put the inflation genie back into the bottle. In the latest Senate hearing, Powell revealed his hand and we have to prepare for chaos. In his testimony before the Senate Banking Committee, Powell was cornered and he revealed deadly truths. Listen to this exchange between him and Senator Kennedy. Kennedy asked Powell, "You're raising interest rates to slow down the economy, are you not?" Powell responded, "Yes, to cool the economy off." Kennedy followed up, "And one of the ways you measure your success is the unemployment rate, is it not?" Powell finally admitted that it is one of the measures indeed. Now, Senator Kennedy then projected if history repeats itself, the unemployment would have to raise to 7% just to get inflation down to 4.4%, which Powell had no choice but to agree. And this tells us that the Federal Reserve is on the train to unemployment land. Remember the Fed's bipolar dual mandate, the promised land of both low inflation and maximum employment. But we need to look at the external signs, the superficial metrics which Powell is still looking at. Inflation is still at 6.4%, rising 0.5% in January, but unemployment is still at a record low of 3.4%, with job openings staying elevated. And we all know service sector's job and not really painting the true picture, but Powell doesn't care. All he sees is a tight labor market. And here's the big one. Powell just confirmed his conviction to crush inflation at the expense of jobs. And it's important that we pay attention to his sparring session with Elizabeth Warren. She asked him, "How would you explain your view that people need to lose their jobs?" And he told her the truth, saying, "I would explain that inflation is extremely high and is hurting the working people of this country badly, and we are taking the only measures we have to bring inflation down." And this is where things get really brutal. Warren asked him, "And putting 2 million people out of work is just part of the cost and they just have to bear it?" Now, Powell almost lost it and fired back. Will working people be better off if we just walk away from our jobs and inflation remains 5 to 6%? Now, the writing's on the wall, guys. He knows there's no escaping the pain and he's prepared to be the bad guy. If everything comes crashing down, Jerome Powell is prepared to be the villain. And the market knows this well. They know that eventually interest rates will have to go higher than the inflation rate. Remember that back in the 1980s, inflation went well above 12%. It was crazy high, and the Federal Reserve, they had to hike rates to 20%. Yes, rates had to go much higher than inflation and it stayed elevated for quite a few years. We have traders on Wall Street all betting that the Federal Reserve is going to hike to 6% or more. Hedge funds are starting to bet heavily that the Fed is going to tighten all the way to 6% in December and still stay above 5% by June 2024. So we really need to sit back and ask ourselves, how much more can the economy endure higher interest rates? Because the collateral damage will start with the stock market and the real estate market. And if those collapse, investors will start to get freaked out and run away. Then we could start to enter a deadly asset deflation spiral. So let me put on my Dr. Doom thinking cap and analyze how bad the situation can really get. Now, I'm not saying that a collapse is coming tomorrow, but we have to take higher rates more seriously. And let's just take a look at the Shiller P ratio. It is still at a crazy high of 29 compared to the mean of 17. Wall Street is still overvaluing stocks. All it takes is for a serious earnings recession to hit equities, and we could see the multiples readjust back to reality. We have Morgan Stanley telling us that the markets are on borrowed time and US stocks are about to crash again. They also pointed out to the overvalued P ratio, showing that stocks are just as overvalued as they were before last year's crash. Now, obviously, this isn't good news, but we are still in a downtrend in equities. You could see the S&P revisit the lows of 3,600 again, at the very least before a rebound. Now, I want to say that that's as bad as it will get, but if we look at real estate, the picture is just as grim. Now, homeowners, they have already lost $2.3 trillion from the recent housing correction. But we know rates are going to keep heading up, possibly all the way to 6% or more. Just take a look at Bank of America's APR rate, which includes the interest rates and other fees. It doesn't matter what type of mortgage you are getting, a 30-year fixed rate or 10-year adjustable rate, you are still paying over 7% just to get the loan. So if Powell hikes the Fed funds from 4.5% to 6%, just imagine how high mortgage rates will get. If mortgages hit 8 or 9%, I think we'll see a generation of people just giving up on home ownership. The monthly payments will be near unaffordable. So how bad can real estate crash? Now we have the Federal Reserve themselves telling investors to brace for a 20% drop. And they have backed it up with some terrifying evidence. And according to this chart from the Fed, we can see the US housing market is in huge trouble with a big correction looming. The price to income ratio is a very popular measure of how affordable home prices are. The higher it is, the more unaffordable housing is for people. And what do we have? The US price to income ratio, which is the black line, has skyrocketed to 116 today within just 2 years. The rest of the world is under 90, showing that American home prices are out of whack. This is even higher than the price to income ratio back in '07 before the '08 housing collapse happened. And if a crash happens today, this is going to be very painful. We are looking at a 19.5% decline to bring American housing back in line with its fundamentals. So just be aware there's likely more downside to go in property prices. And it's not just residential real estate that's in trouble. Commercial properties globally are also plunging to hell thanks to higher rates. We have a massive real estate player, Blackstone, defaulting on a 530 million euro bond backed by real estate. They even blocked investor withdrawal in their $71 billion property investment trust. Now investors, they are running away from real estate, and the chaos is so bad they are blocking redemptions. And this is only going to get worse as Powell continues to hike rates because central banks around the world, they take their cue from the Federal Reserve, especially the ECB. But that is just the tip of the iceberg. We know how bad things can get as rates go up, right? People get poorer and spending will dry up. And it isn't just higher rates, they are sucking money out of Main Street. The Fed is also sucking money out of Wall Street and the big banks. Now, the Federal Reserve is still deleveraging its balance sheet. They have reduced their US bond holdings by over $600 billion. Plus, if we look at the reverse repo facility, we can see over $2 trillion still hiding inside. The big banks, they're not circulating their money in the economy because the Federal Reserve has set up the ultimate risk-free trade for them. There's no point in loaning money or giving mortgages when the reverse repo rate is at 4.3%. That's above the 10-year yield. It's free money with virtually zero risk. So just imagine what will happen as the Fed funds rise towards 6%. We will see the dollar index continue to move up as well. Yes, it sounds great for the US consumer. A stronger dollar seems fantastic until you realize it destroys global demand as well. A stronger dollar pushes many emerging economies closer to a currency crisis, and when their inflation soars, no one has money left to buy American-made goods. So everyone loses, but rates still have to go up because inflation is just too high. So brace for impact, guys. The S&P has already crashed to 3,900, and something tells me that this collapse isn't over yet. But let me know what you think in the comments below. Will the Federal Reserve hike rates to 6% or even higher? Are you prepared for economic collapse? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through this crazy time.